Of course, comes out of Europe. European leaders met in Brussels today to hammer out a Greek rescue plan and one that limits contagion risks. There is no final communique out as yet, but here are the broad contours as per Reuters that has accessed a copy of the draft statement. Let me take you through some of the key highlights. The proposed approximately 115 billion euro second Greek rescue package would involve both more official funding from the Eurozone Rescue Fund, that's the EFSF, and the IMF, and a contribution by private sector bondholders, as well as Greek privatization revenues. Now, the package includes a bond buyback, a debt swap, but it does not include a new tax on banks that was much feared by banks, and banking stocks have rallied on the back of that news today. The key development is the enhanced flexibility of the EFSF. The rescue fund would be able to lend to states on a precautionary basis instead of waiting until those countries are shut out of market funding. They will also be able to recapitalize banks via loans to governments, even if those banks are not under an EU IMF assistance program. And this more flexible EFSF would also be allowed for the first time to intervene in the secondary bond markets. This, of course, subject to ECB conditions. EFSF loans to Greece, Portugal and Ireland will be extended to 15 years from the current period of 7.5. The interest rate will be cut to around 3.5%. That is from the current 4.5% to 5.8%. So this should come as big relief for those three beleaguered countries. Now, European leaders were also set to promise what they're calling a Marshall Plan of European public investment to help revive the Greek economy. And here's the big D word: they're not ruling out a selective default. Here's what Dutch Finance Minister Jan Hager said, that a short-term or selective default for Greece, which has long vehemently been opposed by the ECB, is now a possibility. Well, for more on what more we can expect from that meeting, especially in a final communique, I'm joined by Sylvia Vadva. She's been keeping an eye on all the latest developments. Sylvia, it looks like we seem to be closer to a resolution.
Let's put it this way, we have been on a bit of an emotional roller coaster ride here, the markets as well as us journalists here on the ground, because this morning when we headed into this, it looked very much like a deal was almost done and dusted after a 7-hour meeting, a mammoth meeting, hacking it out between Angela Merkel of Germany and Nicolas Sarkozy of France in Berlin before they even headed to Brussels here. It looked like everything was more or less paved for a quick agreement. Then this afternoon it indeed looked like it. We heard that sooner or later we were going to get a communique on the table. The first rumors were trickling through about lowering of interest rates for Greece, about stretching the maturities, about more firepower for the European stability mechanism, and indeed about the ECB having budged on this collateral issue. All that seemed to be in the pipeline, but then it turned out that some of the fine print evidently couldn't be agreed upon, or some of the wrinkles had to still be ironed out. The meeting was interrupted. They went out again to their separate ways to resume the meeting, and we had to wait on for a result as we moved along. So bottom line is, it seems there is a deal almost tangible, almost graspable on the table, but we haven't got it in our hands yet. And of course the markets and indeed everybody here on the ground is waiting for what the final communique is going to look like, and especially what we're waiting for is the D word going to be in there somehow, whether it's partial default, technical default, short-term default, temporary default. Is the default word for Greece going to come in there one way or another? And what is going to happen to private sector involvement? We still haven't quite worked out what kind of the share of the private sector could be after the rumor mill told us the special bank levy, the special tax for the banking system is off the cards, because that's why bank shares shot up here, going through the roof. But bottom line is, we still haven't got the details, we still haven't got the fine print, and we still haven't got the final communique on the table.
All right, Sylvia, thanks very much. We're waiting for that. Quick check on the euro, which rallied about 1% versus the dollar today on the back of hope that there will be a final resolution with the Greece issue, as well as some curtailment of the contagion risk, now currently up 0.8%. For more on what this means, we're joined now by Sarah HEWIN, Head of Research in Europe at Standard Chartered Bank. Sarah, are you encouraged by what you hear of what could be the draft statement? I understand we're awaiting a final communique, but it seems to involve a little bit of everything. a bond buyback, a debt swap, enhanced EFSF flexibility, but it doesn't involve the tax on banks, and it doesn't say anything as yet about a selective default.
Yes, that's right. I mean, we've got some results which are obviously very positive, and the market has read it very positively. The problem is, though, on the crucial point, the private sector involvement and whether that leads to a default rating, that hasn't been clarified yet. So I think that although what's been announced already is very positive, certainly in terms of increasing the flexibility of the EFSF, the EU bailout fund, the crucial point is, will Greece be pushed into default or selective defaults over the coming days?
And connected to that, Sarah, is the issue of whether the ECB is accepting of these several terms, conditions and new aspects of this draft statement. We do know that the IMF's Christine Lagarde was apparently at that meeting today, but I haven't read or heard anything of whether the ECB is okay with what seems to be coming out of this EU leaders meeting.
No, all we've had are some suggestions, some reports, not direct from the ECB, but other people reporting that the ECB is adopting a more flexible approach on a temporary default rating for Greece. But until we get confirmation of that from the European Central Bank, I think that we can't, really tell what the outcome is going to be. I mean, the problem is that the ECB has previously been quite adamant that any defaulted Greek debt will not be allowed to be used as collateral, and that will cut the Greek banking system off from ECB liquidity. So it's a very, very big issue. Now, if they are prepared to accept defaulted Greek debt on a temporary basis, that does change the terms. It does allow private sector participation without the EU needing to replace that collateral. But this really is the key point. I think the worry is that we haven't got a definite statement yet. It sounds as if there's still negotiations ongoing, and we don't know when we will receive the final communique.
Well, Sarah, that's exactly what CNBC's Sylvia Wadhwa was just telling me a short while ago. Sarah, one final question, since we are awaiting the final details, and any deep analysis is possible only once we know all the contours of this package. I think the criticism so far has been that no solution to Greece as yet has been comprehensive, that it has simply meant kicking the can down the road. It hasn't included every aspect that a rescue should. Do you believe that this, to some degree, meets with the needs of a comprehensive rescue package, because it brings in EFSF flexibility, because it brings in to some degree a bond buyback, a debt swap and all of that, and if we do get clarity on private sector participation, then this will be a comprehensive package that will eventually deflect a default or avoid one, or contagion as well?
Well, I think in some ways, it does promise to be a comprehensive package, in that it deals with all the issues that have been raised in recent weeks, which were holding up an agreement. The problem is that it doesn't offer really a comprehensive plan for Greece. It will help Greece, easing the terms of the current EU loan and the forthcoming loan obviously makes it easier for Greece to service its debt, but the key issue is that Greece's debt remains extremely high, and I think that market participants are still likely to anticipate at some point in the future Greece will have to restructure its debt, and that there will be haircuts involved. The positive thing is that the flexibility of the EFSF is being enhanced, and that should mean that Italy, for example, doesn't run into so much trouble as seemed likely earlier in the week. I think that that's a very key issue in improving the ability of the EFSF to prevent contagion to other countries. So from that point of view, there has been some good news today.
Sarah HEWIN, much appreciate you finding the time to speak with us. Like Sarah and Sylvia both pointed out,